The shutdown isn't over, and markets are on edge. A few headlines could send stocks soaring or tumbling. Today, I'm breaking down the key signals in policy, housing, and Bitcoin that tell you whether this is opportunity or danger. What's up, family? It's Coach Massey, and you're locked into the Daily Hodl. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Let's dive right in. Quick note though, this is for educational purposes only, not financial advice. If you like deep market context, hit like and subscribe so you don't miss future breakdowns. So, when the US government reopens and the budget deal is finally reached, markets tend to react in two distinct ways. First, there's usually a relief rally. Uncertainty that has been holding back corporate guidance, government contracts, and economic data disappears, and capital flows back into the market. Investors breathe easier and risk assets often jump. Second, that initial rally can fade quickly if the fiscal agreement signals higher deficits or heightened inflation risk. In other words, the short-term optimism can be tempered by longer-term concerns about interest rates and broader market economy, basically macro. So here's what to watch for in the first 72 hours after the shutdown ends, hopefully soon. Treasury yields. The 2-year and 10-year notes are the first to move. A sharp rise in yields indicates the market is pricing in higher rates or flat rates or anticipating larger government debt issuance. Next, short-term liquidity. Pay attention to money market flows and demand for T-bills. If cash rushes into safe assets, risk appetite is low, even if the market appears to rally. Next, corporate guidance. Listen closely to Q&A sessions from companies that delayed guidance during the shutdown. If companies are cautiously optimistic, the rally has a cleaner foundation. If guidance is conservative or cautious, that's a warning sign that the rally could stall. Next, investor playbook for this immediate window. Consider small tactical exposure to beaten down cyclical sectors if the rally appears balanced and yields remain stable. If you see spiking yields and widening credit spreads, it's smarter to step back a little bit and wait for confirmation before committing capital. This approach balances the opportunity from relief-driven motives, such as like short-lived fragile rallies. So be careful. So let's talk about something else, a 50-year mortgage. At first glance, it sounds tempting. Trump thought it was a good idea. Lower monthly payments, easier qualification for home buyers. It feels like it's a possibility, but affordability is more than just a math problem. Stretching a mortgage over 50 years doesn't lower home prices. It only really changes how payments are spread out. By making payments smaller, it can actually fuel more demand without adding supply, which pushes prices even higher. There's also a hidden risk in the financial system. Lenders and institutions holding these ultra long-term loans are exposed to greater interest rate risk. Longer durations make the housing finance system more sensitive to shocks, which increases systemic fragility, in my opinion. And for households, the consequences are real. A 50-year term slows equity building. Buyers carry high debt for decades, limiting their ability to move, refinance, or invest elsewhere. Mobility declines and financial fragility, well, it rises, unless it's like a 2% rate, of course. And the distribution effects are worth noting. While lower payments might help some buyers, the biggest gains often go to wealthy investors and institutional players who already have capital and flexibility, rather than ordinary families. So what's a smarter structural solution? In my opinion, mortgage portability. It preserves the benefits of low rates while allowing people to move freely. It encourages housing supply turnover, supports better allocation of homes, and strengthens the system without inflating prices or creating new risk. You see, mortgage portability is the ability to sell your home and take your existing mortgage, along with its low rate and favorable terms, to your next property. This matters because it helps unfreeze the housing market. Right now, many homeowners feel trapped. They'd like to move, but they don't want to give up that historically low mortgage rate they locked in for, a few years ago during COVID. That hesitation keeps inventory tight and prices high. With portability, the barrier disappears. People can move for work, family, or lifestyle reasons, or even politics, without facing a massive financial penalty. As mobility returns, more listings hit the market, and prices, well, they begin to stabilize. So portability also focuses on mobility rather than long-term debt. It preserves the value of your existing mortgage rate or your option value and allows the system to function more efficiently. Instead of homeowners staying put for decades buying bunk beds just to protect their financing, they can move freely while keeping, well, what they've already earned, a great rate. And finally, mortgage portability encourages supply rather than artificial demand. Extending loan terms to 40 or 50 years might make payments look smaller, but it only fuels more demand without adding homes to the market, in my opinion. And that pushes prices even higher. Portability, on the other hand, unlocks movement, encourages turnover, and helps create a healthier, more balanced housing market for everyone. You also have practical signals that portability is being adopted or debated. You see consumer mortgage transfer programs, changes in secondary market rules, announcements from Fannie Mae and Freddie Mac. Those are the levers that actually increase housing throughput. We also have Michael Saylor saying to buy now. He has a public history of using volatility to increase accumulation. We're talking about Bitcoin now. But what does that really imply for you? First, big buyers see capital cycles differently. Institutional accumulation at scale needs dislocations. Saylor and MSTR, they don't mind drawdowns. They have more money. They have the same, probably higher conviction, and Bitcoin remains attractive to them. Second, Saylor has network effects. His calls mobilize capital and attention. That can create short-term flow, but it's not a timing guarantee. Third, always ask what has changed. Is there new on-chain accumulation by whales? Are miners reducing sell pressure? Are institutions shifting allocations away from cash and into Bitcoin? These are the objective confirmations to seek after a tweet like that from Michael Saylor. If you are a long-term believer like myself, use Saylor's tweet as a reminder to check your buy plan, not as a substitute for one. You see, if you are a trader, watch whether this call moves futures funding, open interest, and exchange flows. We already talked about immediate market reactions. Now let's list the specific signals that, together make a high probability bottom signal for risk assets and Bitcoin after the shutdown ends. Sustain yield stability. So if the 10-year treasury calms or recreates or retreats after the initial move, risk assets have, real breathing room. So that's great. We also have liquidity reentry. Money market outflows into risk assets, not just into yield, right? So it could be good. Low levels are positive. Then you have corporate guidance improving. Companies start raising outlook or at least stop revising downward. And then you have on-chain Bitcoin accumulation, net exchange outflows, increasing balance in cold wallets, large wallet inflows into accumulation addresses. Fear contraction and the fear and greed index we already saw is 14. You have credit spreads compressing. If corporate high yield and investment grade spreads tighten, credit markets are endorsing risk. And a bottom rarely shows up with just one green light. It is a cluster. When most of these lights turn green, you have a higher probability scenario for bottom information, or bottom formation, I should say. And then practical actions you could take. I want to give you some. Reassess liquidity. Keep a 3 to 6 month cash cushion. If the shutdown ends and volatility spikes, you want optionality. Staged entries. Use dollar cost averaging for long-term positions. If you're building a conviction bag, basically of Bitcoin, plan purchases over weeks or months to avoid timing risk. And then use signal-based scaling. If 2 of the 6 bottom signals flip green, add incrementally. If 5 flip, add more. If yields spike and credit widens, reduce risk. Then there's hedging. Use small hedges for short-term exposures. Options can protect downside if you are good at trading. In real assets, if portability or other housing fixes gain traction, watch local housing data and information for opportunities. And don't forget about your mental capital. Prepare your plan and stick to it. Volatility tests your psychology. Be ready to act without panic. Family, I want to hear from you. When the shutdown ends, do you expect a clean relief rally or a short-lived bounce followed by fresh volatility? And would you support 50-year mortgages if they made monthly payments lower? Or do you prefer mortgage portability that frees up supply like I believe? And Michael Saylor's tweet. Are you stacking now or sitting on the sidelines? Drop your answers in the comments. I read every single one and will reply. If this helped, smash the like button, hit the bell notification, and subscribe for daily Bitcoin and macro updates. And remember, this is for educational purposes only, or purposes, not financial advice. Do your own research, just in case. That's your daily hodl. Stay sharp, stay disciplined, and as always, lead, pray, hodl. I'll see you in the next one. Happy Saturday.